Good morning, and welcome to our webinar on unlocking private markets, discussing how KraneShares is providing access to leading private firms. My name is Jonathan Shelon. I'm the Chief Operating Officer at KraneShares, and I'm joined by the legendary Dillon, CEO of AG Dillon and Portfolio Manager of our Private Fund Series. Aaron is a specialist in private investing and is sourcing companies in the most effective way. Welcome, Aaron.
Thanks, Jonathan. Appreciate you having me.
Of course. Before we get going, I have a favor to ask. We want this to be an interactive and lively conversation. In fact, we plan on spending about half of our time today in Q&A format. We're live streaming this presentation, and we're doing that on our website at KraneShares.com. But we're also doing it on Zoom. If you're viewing this website, please email info@KraneShares.com. And if you're in the Zoom, please submit your questions via the Q&A button at the bottom of your screen. Additionally, we are offering a CIMA and CFP credit for watching this, and you can email ce@KraneShares.com with your CIMA or CFP number to get credit. Next slide, please. Now, at KraneShares, we manage nearly $13 billion in assets across 36 ETFs, and are best known for delivering innovation and providing access in hard-to-reach places: China, climate, liquid alternatives. What's less well known is that we have a subsidiary called Krane Capital Management, and it was created specifically to deliver private funds to institutions and accredited investors. The strategies that we will review today took a long time to develop and were only possible because of a phenomenal partnership that we have with Aaron, MSCI, and S&P. Next slide, please. Now, historically, investing in private companies has been hard. If you're not a multi-billion-dollar institution, accessing emerging technologies and the world's leading unicorns was really a non-starter. And even if you managed to gain access to a single name that was interesting, say SpaceX, you had this concentration risk and could be challenged in understanding valuation and ongoing pricing. To add insult to injury, if you were serving clients as an advisor, reporting and system integration was also a challenge. So we took our time and wanted to create strategies that addressed these concerns and many others. One was giving you access to fill the gap. There are north of 1,000 unicorns right now, and many of these companies are slated to go public. Why shouldn't you have access to them today? Not owning them is leaving a hole in your portfolio. Two, exposure. We wanted to make sure that some of that historical concentration risk that you may have had by investing in one and two names was addressed by having a systematic methodology that was evolving with different vintages over time. And we partnered with phenomenal index providers, MSCI and S&P, to build these 10 company portfolios that are equally weighted, giving you broader diversification and the ability to invest in different vintages. And finally, we wanted this to be easy from a client experience standpoint for our clients and for advisors. So we've made sure that each one of these strategies, as they go live, will be available on Schwab and Fidelity, and that will streamline many of the processes that advisors have. There's also an opportunity to buy the funds directly from KraneShares if you don't use those platforms. So let's dig into this a little bit deeper and talk about the nature of this opportunity. What's really interesting is that over the last 30 or so years, the number of public companies available to investors has shrunk by half. I remember as a young man in this business asking my boss, why does the Wilshire 5000 have over 7,000 names in it? Like, who picked this branding? And interestingly enough, if an analyst were to start in the business today, they might say, well, why does the Wilshire 5000 have 3,700 names in it? The name count has literally fallen by half. Think about that. That's significant. But what's going on? Why is this happening? Jump ahead to the next slide. Well, you might think that a lot of it has to do with companies being taken out, going private. So public companies going private. But the real answer, or a bigger factor, is that companies are staying private longer. Just in the last decade, the number of years that it's taking a company to go public has increased by 4. So it used to be in 2014, typical company would go public in 7 years. Now it's close to 11. And this trend is occurring because the number of companies that are PE backed has actually increased 6x over the last 30 years. So companies are taking their time. They're not in a rush to go public, but they've become very valuable in that process, and they should be a part of your portfolio. If you think about it, just jump to the next slide. There are now over 1,000 unicorns that exist. So these are companies that are private companies that have a valuation north of $1 billion. And you could see that in 2022, the number of companies that exceeded $1 billion valuation, private companies, is 1,000. And then today it's north of 1,200. Now, what's really interesting is when you think about this, jump to the next slide. What does it actually mean? Well, let's look at the top largest unicorns in the marketplace. So here are the top 10. SpaceX at the top, Canva at the bottom. Now think about Canva for a second. That is number 10 on the list. It has a $42 billion valuation. Compare that to, say, the smallest company in the NASDAQ 100, which is Lululemon. Lululemon only has a $20 billion valuation. So what's fascinating is that if Canva was judged on size alone, it would very much make it into the NASDAQ 100. And someday it may. So let's talk a little bit not about the smallest firms on this list, but some of the top names: SpaceX, ByteDance, OpenAI, xAI, and Anthropic. Where do they rank within the public markets if they were public companies? Let's jump to the next slide. Well, what's really interesting is that SpaceX, ByteDance, OpenAI, xAI, and Anthropic rank within the top 25. So think about how wild that is. You have the 5 largest private companies that, if public, would be within the top 25 public companies. That's kind of amazing. And it tells you the give up in terms of opportunity if you're not investing in these firms. So even putting performance aside, because admittedly, these firms have increased meaningfully in valuation, but just the notion that 1 out of 5 companies at the top of the NASDAQ are missing. Kind of amazing. By the way, just a selfish plug, for those investors that are not accredited, they do have a way of owning xAI and Anthropic through our ETF ticker AGIX. So AGIX is roughly 85 to 90% public companies, 10 to 15% private companies, and actually owns xAI and Anthropic today. So separate from what we're talking about here, but I just wanted you to know that for those that are looking for a streamlined, easy ETF solution that has some private company exposure, AGIX is definitely one to look at. Let's jump ahead to the next slide. What I'd like to do is turn things over now to my good friend Aaron, and he's going to discuss how we partnered with MSCI and S&P and the important exposure that is created here with these 10 company indexes. We did something a little bit different between MSCI and S&P, and Aaron will get into that. But Aaron, I think it would also be helpful if you could tell us a little bit about these companies and how they differ from one another. Now, you've forgotten more about these firms than I'll ever know, but what I do understand is that some of these companies are clearly platform firms, other focus on AI infrastructure, and some on defense.
Right.
Why does that matter? And why do the vintages play a role as we think about investing in private companies? So Aaron,
sounds good. So
over to you.
thank you, Jonathan. I appreciate that. So maybe first we'll just talk a little bit about the indexes themselves, right? So as Jonathan noted, the target list for pre-IPO stocks for each fund is determined by MSCI and S&P. The MSCI index is global and the S&P index is US only, right? So two different kind of geographic coverage areas there. Both indices have a similar type of index methodology. So we start with the full investment universe of pre-IPO stocks. Those are screened by liquidity for secondary market liquidity. So if a stock does have good secondary market liquidity, it's included in the potential investable universe. And then it's sorted by valuation, kind of current secondary market valuation, and then the top 10 stocks are selected in each respective geographic region, right? So 70% of the MSCI index is allocated to US names, but also has exposure to China, Europe, and Australia, which are represented by ByteDance, Revolut, and Canva, respectively. And both indexes have solid diversification across emerging technologies. And that kind of really speaks to your point there, Jonathan. So just to spotlight a few of these emerging technologies, right? We have space payload delivery and satellite internet services with SpaceX. For AI large language model platforms, that's OpenAI, Anthropic, and xAI. So that's the large language model businesses, ChatGPT. A lot of folks are familiar with that, or Claude at Anthropic. And then for defense technology, which really what we're talking about is AI-powered weapons for military use, is Anduril. And then lastly, kind of an interesting one to look at is online payments and really crypto payments now that the Genius Act is passed with Stripe. So to dig into kind of one or two of the companies specifically, we'll look at, Starlink, which is the satellite internet product, is the division of SpaceX. So over 2 billion people on the planet have no access to the internet, if you can believe that. So think about large parts of Africa, South America, and Asia. Starlink is going to be the first time that these folks will be able to access the internet. So we believe that Starlink is going to be the largest subscription service globally in a few years' time. That's hundreds of millions of paid subscribers, right? And this is going to drive massive revenue and net income for SpaceX in the future. Looking at OpenAI, this is the company behind ChatGPT. And ChatGPT, of course, is their large language model product. They've reached 700 million weekly users recently. That's up 40% in just 5 months. This is a very fast-growing company. Our math has ChatGPT being used by 17% of the global population with access to the global internet. ChatGPT launched in November of 2022, so that's just 3 years, where 17% of the population is using it. OpenAI's got currently has $12 billion annual revenue run rate and is targeting to be at $13 billion by the end of 2025. That's a 225% year-over-year increase in revenue. So it's really impressive growth. And then last, we'll just talk quickly on Anduril. So Anduril's Lattice AI works hand in glove with Anduril's drone and surveillance hardware to deliver kind of superior battlefield results. Anduril and Palantir are really the darlings of the defense technology space, in my opinion. And the defense technology historically has used the cost plus model, where defense primes would charge a cost of a weapon plus or a product plus 15% markup, for example. this pricing structure leads to missing budgets and delivery timelines more often than not. So Andrew leverages kind of a more traditional business model. They make a product first and then sell it to the Department of Defense in the US or other kind of Western countries. And Andrew solutions are less expensive and often delivered ahead of schedule. It's very different. So this lets the company command a higher net income margin versus its competitors. And Andrew is gobbling up market share, right? So just this past week, Andrew announced that they won 2 new contracts, one with for 1.1 billion with the Australian Navy for autonomous submarines, and another for 159 million with the US Army for AI-powered night vision and augmented reality goggles, right? And then maybe last, just as Jonathan highlighted also with the vintage model, I really like the vintage model because it offers diversification over time, right? So as we snap a vintage and close a fund and we go out and buy the stocks, when we bring that next vintage over time, I think it really offers an opportunity to diversify across different types of emerging technologies. So like a perfect example is if you were to invest into venture capital 5 years ago, AI really wasn't an opportunity. So AI infrastructure, AI platform, AI apps, these are all kind of emerging asset classes or sub-asset classes of AI that just wouldn't have existed 5 years ago. You would have missed the opportunity. So this vintage model really keeps providing refreshed looks in the emerging technology space to take advantage of. Let's do the next slide. Okay, so one question I get asked a lot is how do you actually access the pre-IPO stocks, right? So we purchase the pre-IPO stocks through the private secondary market. So just like when you buy Amazon stock on the public stock market, you don't buy Amazon stock direct. You buy it from another shareholder that is looking to sell. And that's exactly what we're doing here in these funds, but we're doing that in the private stock market. So as Jonathan mentioned earlier, pre-IPO stock companies are staying private for longer. This means that life can happen and valuations can increase higher, go higher while these companies are staying private. So if the pre-IPO stock shareholder is a natural person, let's say an employee of a company, right? Not to be cheeky, but they could die, they could get divorced, right? Their spouse could want to buy a vacation home, so they'll want to sell, right? If it's an institution like a pension, endowment, foundation, or an investment fund, the position may have appreciated so much that the institution is outside of their asset allocation guidelines, right? It cannot have that high of an allocation or concentration to one stock. It can't have that high of allocation to venture capital or alternative funds in general, right? And of course, any existing pre-IPO stock shareholder may just want to sell and take gains. So if they're up 3x, 4x, 5x over a short period of time, that's a natural place to sell. So these are all like natural, rational reasons to exit a stock position. Financial innovation happens and the capital markets find a way to meet these sellers' demands to get liquidity. So more tactically, what does this mean, right? We gain exposure to pre-IPO stocks from an employee looking to sell or an investor in a venture capital fund that participated in an earlier round and is looking to sell. And the technical term for this is acquiring LP interests, right? So venture capital funds will often put highly appreciated positions into a venture fund that only has one holding. So some people call this a special purpose vehicle or SPV. And SPVs are very similar to public market ADRs, in my opinion. So that's a pass-through entity that provides exposure to a single stock. So again, either one, we get direct exposure on cap table if we're purchasing from an employee, or two, we are either on the VC funds cap table if purchasing LP interest in an SPV. Okay, in either case, the key is to conduct robust price discovery. This is very important, in my opinion, to ensure that you're getting best trade execution. And as fiduciaries to the fund, this is something that we're very focused on. Trading pre-IPO stocks is very similar to trading fixed income. There are many market participants, but you have to be a trusted counterparty to these folks. So experience matters and relationships matter. The key is to develop that trusted relationship with high quality counterparties so that they'll deliver offers to you on request. And the more offers that you get, the better price discovery you have. And we believe that will lead to better trade price execution. So we have over 50 institutional pre-IPO stock broker and venture capital firms that we trade with. These folks give us outstanding price discovery on every trade that we do. On average, we get 16 offers per trade. So that's great price discovery. And we sort those offers highest to lowest and complete counterparty due diligence. And if the offer passes due diligence, we execute the trade. So it's really very important to make sure you work these trades and get really great price discovery so you can enter the position at the right price. Okay, next slide, please. Okay, so here's some trading results from some pre-IPO stock trades that we did and executed in the first half of 2025. Here we have trades in Anduril, SpaceX, OpenAI, XAI, Grok, which is a semiconductor company, and Figure AI, which is a humanoid robotics business. We had great price discovery. You can see that, well, you can see the great price discovery in the numbers, the number offers, excuse me, the total quality of offers that we have for this. We also list the low, high, mean, and median statistics relative to each trade, right? The second table here shows the offer spread for these trades. This is important. So 35% offer spread to 53% was the range for these 6 particular trades. That's the lowest offer to the highest offer. You can drive a truck through that. So this is not letting, you know, a highly illiquid ETF trade go through market order and it's a half penny spread, right? This is a huge spread, right? And this really highlights why it's important to conduct proper price discovery. If you simply take the first offer that you get when you trade in the private pre-IPO stock market, you run the risk of getting your face ripped off. So price discovery is key and best execution is key. All right, so we're very proud of this trading process. We believe it's repeatable, it's robust, and it's delivered outstanding results for us over time. We've worked really hard to build and maintain these counterparty relationships, and we do believe it makes a very big difference to our clients. So, all right, Jonathan, I'll hand it back to you.
Great, Aaron, thanks. And, you know, early on, I spoke about the availability of these strategies on platforms like Schwab and Fidelity. We expect in the next 1 to 2 weeks that both of these strategies that we have will be available. So this is all happening in real time. But there's also a way to buy these strategies directly from Krane. Again, this isn't, you know, these aren't ETFs, so you have to go through a process. They're for accredited investors. But we have been very thoughtful about client experience. We recognize that historically, investing in things like this were not always associated with a good client experience. So we've worked very hard to streamline using technology, right? If we're going to invest in technology, we might as well use technology to make the process more straightforward, use DocuSign, have streamlined AML, KYC, and so on. But all of that starts by you know, going and sending your information to info@KraneShares.com, and then that will initiate a process where we connect you with our tech portal, create your investment profile, and then finally go through a streamlined KYC framework and assess suitability. Now, as you would expect, there are certain constraints that we have to operate by. So we take on indications of interest, and then we determine who gets to enter into a particular vintage. And we'll spend more time on that during the Q&A session. But I just wanted to make sure that folks recognize that if you aren't going to be, and even if you are going to be using Schwab and Fidelity to purchase these strategies, you should still reach out to info@KraneShares.com to make sure that we can be as helpful as possible through that process and help guide the way for you. So at this time, I'm going to have us go into the Q&A part of our presentation. We have a number of phenomenal questions that are coming through as we speak. And before we do that, or as we do that, I don't know if, okay, good. We've got the Q&A slide up. Aaron, you know, why don't we start? I know you talked a lot about trading and the importance of trading. I think what may get some people a little bit surprised is that you can even buy these pre-IPO stocks, right? You talked about numerous ways to achieve price discovery, an enormous network that you have to get that discovery and get good execution, best execution. When did that start to occur, right? Like, Because 10 years ago, could you do that? And, how deep is this market really? Are we talking about, oh, I can go and buy, 500K of SpaceX? Or could I really go and get meaningful exposure in some of these names? And mind you, we are targeting the largest names in this space, so we have a bias, but just curious about the evolution because it's not something many of us were familiar with, even a decade ago.
Right. Yeah, it's a great question because a decade ago there was no secondary market liquidity, right? I mean the whole term unicorn, right, was kind of cemented in the fact that once you hit $1 billion valuation, you'd go public, right? So
Mm,
that's just not happening anymore. To kind of to your point earlier. So and then not only are folks waiting, they're kind of passing by the $1 billion valuation mark, but they're going many, many years after that, and the valuations are going up much, much higher. So it's just logical, right, that folks would want to get liquidity for all the reasons that I mentioned earlier. But I think, Jonathan, it's kind of a tip of the cap of the American capital markets. Like in the absence of stocks going public or companies going public, the industry kind of rose to the occasion and found ways to bring liquidity to shareholders, right? Whether that's a shareholder of an SPV or a shareholder, an employee who's directly on the cap table, right? So, the capital markets find a way to make the money flow, and that's certainly what's been happening, I think, over the last couple of years. But you're right. I think we've hit critical mass like in the last 5 years, right?
mm,
And in particular, I think since AI has taken hold, that's been in my opinion, that's been a particular driver because a lot of the pure play AI companies are private, right? There's just not, the XAIs, the OpenAIs, the Anthropics, a lot of the AI infrastructure plays are also private companies in the pre-IPO stock space. So that's really brought, I think, a lot of attention to the asset class and and brought a lot of market participants in there too.
mm. So necessity really is the mother of invention. Companies got bigger, market caps have gotten large,
That's
firms are
right.
taking a lot longer to go public. So how do these founders and owners get some liquidity in that process? And that led to this bloom in the secondary market.
I should mention too, though, just to your point earlier on the size or the depths of the market, right? I find them to be very robust. So, you could argue these stocks trade like thinly traded small cap stocks, right? So, you could build a very large position of any one of these names. You may not be able to do that in one trade, right? Just like if you're trading a thinly traded small cap stock, but you can certainly do it over time, and build out a position and be really thoughtful about how you do that. So, but that being said, there's also some very large institutions that are looking to sell in the secondary market too. So, ample opportunity. But that's where, again, I think price discovery is important, because you really need to get out there and understand where the market is at for a particular stock before you start to, execute a trade.
And having real expertise about the companies themselves, but also having data sources. One of the things that's important, we didn't talk about this, but both MSCI and S&P are going to be establishing valuations for these firms and pricing their indexes quarterly, right?
Right.
To
Right.
create a performance benchmark, which is important. And so they're relying on third-party data sources as we are. So,
Mhm.
this is no longer, one of those things where you kind of put your finger in the air. You have hard data that
Yes.
reflects the activity in these markets. So I'm not suggesting that it's like the New York Stock Exchange or the NASDAQ, but you're getting ample data on secondary market activity, bid and offer, and a lot of the things that we in this business are used to. And even that,
Correct.
I don't think was available very long ago.
No, you're spot on. I mean, the market is becoming very institutionalized, right? And that's I think a good thing. So I think much larger players coming in and operating specifically in the private secondary market, right? And then you're getting the tools and solutions that you would expect to see in the public markets show up in the private market. So pricing, pricing transparency, indexing, things of this nature are fundamental to kind of an institutionally run asset class. And all of those things are happening right now, Jonathan.
Mhm. So I want to address, there are a couple of themes I'm seeing in the questions. One thing I just want to be very clear about, and again, it could be confusing because KraneShares has traditionally been known as an ETF company. Most of the 13 billion that we manage is in the ETF space. So some are asking, is this an ETF solution? So when we talk about the 10 private company indexes that we've built with S&P and MSCI, these are in fact private funds. So they do require accredited investor status and the kind of AML KYC process that I mentioned earlier. However, for investors that are looking to do something in an ETF wrapper, we can give you partial private company exposure through AGIX, AGIX. And so good, we're putting that up on screen. You can go to KraneShares.com /AGIX and look at that, and you could see that both Anthropic as well as XAI are part of that portfolio. Again, it's a 90+% public equity ETF, but has roughly 10%, 7 to 10% in private companies today, and will continue to add to that list. So I wanted to mention that, but that these are distinct, in fact, distinct. And the other comment to make that has come up here is how do those indexes construct that portfolio? And we use an equal weight methodology. In other words, portfolio construction is very straightforward. We take the 10 names that qualify using the criteria Aaron outlined, liquidity and others, and then we just invest 10% across the board. And that's why you heard Aaron also say that MSCI and S&P, those indexes have 70% overlap because 7 of those names are in common. So that's the approach. And then we will purchase those names targeting those same weights that are in the index. Now, there are a couple of questions that came up about what happens if a company goes public inside of these portfolios. So, we invest, some time goes on, and maybe you can even share some of your perspectives, Aaron, on how long what happens first? Is it likely that you would get your capital back,
Right.
through companies going public, or if a company goes public, do you get the shares? Can you talk about some of those types of details? I think they're interesting and important.
Yeah, that's a great question. So the intent with the strategy is as soon as a company has a liquidity event, that we would make a distribution related to that IPO back to shareholders, right? So what is important though, you're a private market investor here. So when a company goes private, you're subject to the blackout period, right? So that can be different for every company, but almost always it's 6 months. So that's important to remember. But once we're past the blackout period, we'll either distribute cash or we'll distribute shares in kind. And the fund itself is a limited partnership. So when we distribute shares in kind, that's not a taxable event, which is nice, right? So if you're investing through a taxable account, that's something to consider, right? So, but that's the intent. And the goal and the hope, if you go back and you look at historical portfolios that we've back tested, there's liquidity that starts to come right away, right? So the hope is that within 4 to 5 years, whatever money you've invested in the strategy, you've now received that back through distributions, and then anything beyond that is kind of pure investment gain as the remaining holdings in the portfolio kind of cycle through. So of course, the ultimate goal is that all 10 companies will have an IPO or be acquired, and we'll have a distribution around those. But it's not a 10-year where we're holding your money for 10 years and then returning it to you. As soon as these companies go public or acquired, we're trying to make those distributions back to you.
Exactly. So this is a closed-end fund, private fund, and so it does not continue on. The idea is to return capital as it's received. And that's really interesting too, right? Because we do know investors have had sporadic access to single private companies over time. And so when we talk about diversification in this strategy, it's not just diversification across AI infrastructure versus defense versus platforms. It's also the diversification of your liquidity profile, because we can't be sure how liquidity occurs at what particular point in time. But some of these companies can go public in a year, 3 years, 5 years, maybe within the 10-year period. and that creates liquidity along the way. And
Right.
so it's, we think, an interesting way of construction, and clients have expressed that that's a benefit that is sometimes overlooked. So another question that we're seeing here is, can I charge my advisory fee? So for advisors that charge a fee for their services, can they charge an advisory fee on this fund?
Yeah, so that's the nice part about having the funds available for purchase at Schwab and Fidelity, is that it literally shows up on the statement, the client statement, like a mutual fund would, right? So it flows in almost all cases that I'm aware of, it flows seamlessly through uh, all the billing solutions that are out there, and also all the performance reporting solutions too. And I know some advisors that I've had conversations with are particularly, or they ask the question, like, can I charge an investment advisory fee on this position? The answer is yes. So even if you purchase it directly through KraneShares or directly at Krane, you're still able to charge your investment advisory fee on that position. But of course, having the position in the account at Schwab or Fidelity makes that much, much more simple, right? And streamline administration. So that's one of the big value add, I think, components of going through and getting that Schwab and Fidelity approval, which is not easy to do, right? So hats off to the Krane team for going through that process to get it done. But I think it really helps out both clients and the advisors on the administration side.
Great, Aaron. Thank you for that. Let's get into some of the technicals. We are asking for indications of interest in the fund and commitments. People go through a process, but we do have some limitations, right? In other words, there are a lot of questions about the minimum investment size, which is really nominal for this strategy. For everybody on this webinar, I think that they wouldn't have any issues with the minimum, but there is a minimum size that you have to think about on average, just because of our limitations. So could you get into some of those details and how the process actually works as we approach, closing or making the capital calls and doing some of those things?
Yeah, so the math is pretty straightforward. So for each of these particular stocks, kind of for best execution purposes, or kind of getting accessing like the institutional private stock market, it's really best to trade about $1.5 million minimum, like per stock. That can vary depending on the stock and also what's going on in the market at the time. But as like a general rule of thumb, 1.5 million is like a smart place to be. It's an equally weighted portfolio that puts you at 10 million, 15 million, excuse me, right? So then you're looking at some additional costs. So we've just, fund expenses, audit, et cetera, right? So we're looking at kind of a $20 million minimum to just execute the fund strategy properly. And then to Jonathan's point, this is what's called a 3C1 private fund. So that's accredited investors only. But that the SEC allows us to have 99 investors in the fund, right? So if you just do the math, 20 million divided by 99, that kind of roughly works out to like 200,000. It's like 202,000 per investor. So that's the average. If you want to think about the average assets per seat, per 99 seat, it's 202,000. So if you're an advisor, I suppose we would ask you to think about householding your clients, right? If you have, maybe someone who came in for $1 million, that might open up some opportunities for you to have some of your other clients come in with a lower number, below the 200,000 or 202,000. If you're have prospects and maybe you want to get them in, start a relationship with them, that's also a nice way to do that too. I think if you're an individual investor, I would probably be soft circling that number. If you want to make sure that you fit and get into the top 99, that's probably a nice place to be, is around, just north of $200,000. So that's the math. It's the law, 99 investors per seat. So, naturally you have to make sure you adhere to that. And, but that's kind of the logic around the minimums, right? I mean, I certainly hope we get some very large investors to come in and we can take on a lot of investors that are below $200,000, right? But that's just effectively how the math could potentially work out when we see
That's
all
right.
the business come through.
That's right. That's right. So we're targeting no less than $20 million per fund. We can go higher. But because of the limitation on 99 investors, slots in the fund, we have to have a minimum average size of over $200,000 or around $200,000.
So Jonathan, to that point though, so that we talked about the minimum, I think on the upside, right? Because I believe there's some institutions on the phone too. We're happy. This asset class can handle 100 million, 200 million, $300 million size funds, right? No problem. So, we can go out and build positions in each of these respective stocks, at a high AUM level for this particular fund. So, by no means I want folks to think that we're going to hit 20 million and then cap it out. So if you're an institution or a big wealth management firm and you want to allocate some big dollars here, we can certainly handle that and facilitate it.
Yeah. And the other thing to note is that this isn't a one and done framework. We talked a lot about vintages. So our partnership with MSCI and S&P extends to all future vintages that we're doing together. And that means that our goal is to continue to offer these funds with regularity, to make sure that if you weren't able to get into this particular vintage, there should be another vintage in the coming months that will be available. It will, by definition, have a different set of names. It'll have names that meet that criteria at that point in time. And so things are going to evolve and change. That's not going to happen. These aren't things that are moving very quickly, but you could have tweaks and fine tuning and relative valuations that change the composition. But along those lines, over a period of years, you could see really meaningful changes in the composition. And that's a good thing, because we would encourage people that if they're investing in private companies, that they do invest across vintages. It's great to have 10 private companies in one fell swoop, but why not have 30 by investing in a series of these over a period of 3 years? And therefore you're gaining, imagine, Aaron, you could probably comment on this. Imagine what a vintage like this would have looked like 3 years ago. I presume that the companies would look very different than the companies that we're providing today.
Yep, you're right. Yeah, AI would have played probably a much lesser role within the portfolio. Maybe perhaps some more fintech in there too, right? Some of the companies that are going public right now. But you're right, Jonathan. It would have been a different mix.
Exactly. So there are a lot of, it's great. I think we're covering a lot of the questions that are coming through. There are some questions about fees. How do our fees work? And there's a combination of a management fee, and there's also a participation fee. And so, can you talk a little bit about that, Aaron?
Yeah, so there's a 2%. I would call it your standard 2 and 20 fee structure, right, for an alternative fund. So it's a 2% annual management fee and a 20% carried interest. And the carried interest is on the gain, right, on the position level. So I don't think not too hard to understand. It's very kind of normal standard fee structure for an alternative investment product.
Yeah, exactly. Okay, so there's another. Okay, this is, wow, a lot of incredible questions here. There's a question about investing through an SPV versus going direct.
Okay.
And I think it's valuable. And right, and you talked early on that we could do either. There's obviously a very deep liquid market in these names in the secondary market. But can you talk about the type of access we have and what some of the differences are between an SPV and going direct, and any kind of risk that we have to be thoughtful about as we make these investments?
Yeah, this is a very good point. Okay, so there are pros and cons of investing both direct on the cap table and also through SPVs, right? I prefer to invest through SPVs. And in particular, the reason why is when you invest direct on the cap table, the company approves that trade, which takes time. And more often than not, they also have what's called a ROFR, or a right of first refusal on the trade. So I've been the victim of my own success in the past. If you do a very good job and you find a seller that would like to sell at a very low price, the company may not particularly want that trade to happen. So they'll ROFR the trade. They'll cancel, they'll not let the trade go through. Also important is the ROFR takes time. So that could take anywhere from 30 to 90 days. So I've been ROFR'd on a number of occasions where we've waited, 60 to 75 days only to find out that the trade is not happening. And of course, the market moves in that period of time. So you could end up taking a position now at a much higher price. So typically, when you do an SPV trade, those happen very quickly and they close very quickly. So there's certainty around transaction, which I think reduces transaction risk. But that being said, you have counterparty due diligence risk. So I've done due diligence at both Morgan Stanley and TD Ameritrade on third-party managers. So this is kind of uh, really focusing on due diligence for these SPV managers, which are again just private funds, right? So that have one stock in them. So we go through a number of processes to make sure that the managers that we're investing to, the GPs, the general partners, and investment advisors are high quality, that they're running the funds appropriately, that they're being audited, right, on an annual basis by a third party audit firm. And we're managing that counterparty due diligence risk. So that I think is most important. I think oftentimes too with SPVs, you may find earlier shareholders that are willing to sell, or I'll call it, limited partners of SPVs that are willing to sell at better prices than folks that are on directly on the cap table as well. So, I think as fiduciaries, my mandate is to get the best price available in the market for a particular stock when we go to market to trade in the secondary market. And that may not always be direct on cap table trade, right? So, for all those reasons, it's a very good question, right? But for those reasons, that's the nuances of kind of the pros and cons around an SPV versus a direct trade.
Yeah, I think that's why experienced portfolio management is very important here. Couple of questions kind of in the tax and liquidity camp. Let's start on the tax side. Some are asking about placing these investments inside Roth IRAs or IRAs. Any comments on tax treatment generically, but then also on the suitability of these types of strategies inside of deferred or preferred tax accounts?
Yeah, so the answer is yes, a resounding yes, right? So you can put this fund into an IRA, both traditional Roth. You can do a solo 401k, right? A SEP. All of those are accepted. You could do a self-directed. I know some folks have self-directed IRAs, right? That's a way and you can invest directly through Krane if you had a self-directed IRA to make that investment. If you're with Schwab or Fidelity, it's very simple. The process doesn't change whether it's a taxable account or a non-taxable account. You just effectively title the documentation appropriately and the investment is made. So yeah, this is a great asset class, Jonathan, to have in non-taxable accounts, right? And so highly encourage folks to consider that allocation in a non-taxable account if you're able to.
Yeah. Yeah, you had mentioned this to me in our early conversations. We were contemplating the strategy, and I was blown away by that. I thought, wow, to own a piece of this in my IRA account, that could be really, really beneficial over time. That is
Yeah.
the ultimate long horizon investment strategy for most. And this is very well suited for long horizon investment by definition.
It
It
certainly
comes
is.
with
Yeah.
illiquidity risk, but IRAs are by their very nature illiquid before you reach MRD age. So, if you're saving for retirement and you have forced illiquidity due to the IRA structure, this becomes a very interesting strategy in that context. Speaking of liquidity, there are questions about, can you periodically sell the fund? How does liquidity work? And then a clarifying question on when a company goes IPO, do we get shares back of the partnership here or shares back of the actual company? So if you could
Okay.
talk about some of the liquidity provisions here, that might be helpful too.
Okay, so maybe the second question first. So if there is an IPO, we'll distribute shares of the company back to investors, right? So not shares of the fund, shares of the company back to investors. So you'll have, Stripe stock, publicly traded stock now in your Schwab brokerage account, right? As an example. So that is important. And that, again, that's a non-taxable event, right? So you're not paying taxes on that distribution because we have a limited partnership there. On the liquidity in general for the fund, so it's a 10-year term for the fund, right? As mentioned, when companies go public or are acquired, we have the ability, as soon as we have the ability to make a distribution, we'll ask you whether you want cash or shares, and then we'll subsequently distribute what you prefer to your brokerage account or bank account. And that is a form of liquidity. I view that as a form of liquidity, right? Because we're returning capital back or distributions back to you. But there is an opportunity at the 5-year mark for a liquidity window. That would kind of be the first time to sell in a proper way. And then, of course, at the 10-year mark, we'll ask folks again if they'd like to sell. The nice thing, as mentioned earlier, is there's 99 investors in the fund, so there's not tens of thousands or hundreds of thousands of investors. So I think in our experience, you have a handful of advisors that come in and participate, so you can have a very intimate discussion about what's right, for that particular advisor and for their clients. But that is the liquidity profile. This is when you buy these stocks, it's like buying a house. So it's a lot of work to take a position. It doesn't happen fast. And so selling is not something you can do. So if you have, 200,000, 250,000 in, and something happens and you need the money back in 2 years, it's very, very challenging to be able to facilitate that. So I would highly recommend folks to think about this as a liquid investment, right? You're going to be getting the distributions back as market activities happen and companies go public or are acquired, and kind of that 5-year window is the first real opportunity to sell at a wholesale level.
Right. Very good. And then another clarifying question on fees. We talked about the 2 and 20 structure. One very good question about how does the carry actually work? Do we charge carry on appreciation or on realization?
Yeah. So carry is charged on a per position basis, right? So once we realize that gain in a particular stock, we'll accrue and pay out the carry for that individual position, and it is on the gain, right? So
Right.
there's a
Right.
calculation methodology that we have in place, and I'm happy to. That's specific. That's
Right.
pretty detailed. So I'm happy
Right.
to answer that kind of one-on-one with folks
But just,
they'd like to get
just
into it.
kind of to put that into context, if, we had purchased Anthropic at their E round where they were at 83 billion, or, I actually can't remember. No, it wasn't, it was
61. Yeah, 61 and a half. Yeah.
61 and a half. Sorry. The 83 was recently, their most recent round was at 183.
183.
So even
Yeah,
if
that's
we
right.
had a 3x appreciation in a particular name, if that name doesn't go public or have some kind of event, we're not charging a performance fee on that, right? In other words, a remarking of the portfolio doesn't trigger performance fees or carry. It's
That's
only
right.
when there's an event that occurs. So that's important too.
That's right. Yeah, that's right. I think that it's on the distribution. It's the realized event is when we snap the carry.
Mm-hmm. Okay, I think we're getting close to time, but let's do a couple more here. Or Aaron, since we've probably gone over a couple dozen questions, are there things that we haven't touched on that could be interesting to discuss here in our last couple of minutes?
Yeah, I mean, the market structure is a big one. That's often how I get a lot of questions from folks about how we can actually buy these, because I think people read in the paper and other market participants that, these stocks are just not available for purchase, which, my experience has been that's not true. It doesn't trade like you're buying a public market stock, right? It's certainly much more sophisticated than that. But if you have the right partners and the right transparency, you can certainly take positions and take them in size, right? So, but I think, Jonathan, as you mentioned earlier, like having a good partner to do that I work with a lot of brokers and I love the brokers that I work with, but they're brokers and they're not investment advisors. So I think, in my opinion, stepping into this asset class, it's really very important to have an investment advisor partner, a fiduciary that's sitting on the same side of the table as you are, as you go into market and kind of operating on your behalf. So I think that's what we're really trying to accomplish here for folks in this fund, is to help give them diversified exposure to this pre-IPO stock asset class and do that with institutional rigor, right? So hence the, MSCI and S&P partnerships, and kind of the approach to trading around best execution and really, taking that fiduciary mandate seriously for the fund investors.
Fantastic. So we're bringing what historically has really been only available to a very small subset of investors and making it available to a much larger group, really individuals that are accredited investors.
Right.
However, we have to abide by some of these limitations. And there are investors that are saying, well, geez, if you have a 99 investor rule, even if you're doing 2 funds at a time, and that's 198 investors at a time, what happens if I don't get in? And obviously at Krane, we want to have happy clients, and we're going to work very hard to make sure that you're part of these strategies. But I do want to just remind everyone that this isn't a set it and forget it for us or a one-time deal. We're going to continue to launch these strategies with some regularity. So if you don't, or if you aren't able to access one of the funds, you're going to be high on the list for the next one, and so on. But unfortunately, and again, this isn't our rule. If it was, we wouldn't have it. But we do have to abide by these restrictions that limit each fund to 99 investors. So, Aaron, I just want to say thank you. This has been phenomenal. Thank you for the partnership. Thank you for sharing your insights today. I know I learned a lot, and we talk all the time, but this is so valuable, and I hope it was valuable to the audience. We're very excited to offer these strategies and leading companies to our client base, to our existing clients that we have in the KraneShares ETFs, but also to new client relationships that we're developing as a result of this opportunity. So thank you, everyone, for spending time with us today. If I didn't get to your questions, please send a note to info@kraneshares.com, and we'll 100% have somebody follow up with you in due course. So thanks again, everybody. Thank you, Aaron.
Thank you.